Welcome back to Ace in Accounting. It is so great to be with you guys tonight. I hope exams have been good to you. So today we will be looking at your accounting paper 1, grade 12, trial examination. We will be checking out your question 3, which is interpretation of financial statements. Right, without further ado, let's just get into the question. Okay, so question 3, it says interpretation of financial statements. Please forgive me here. I know it says DBE November 2020, but here it says trial examination 2021. So we're just gonna go with the paper because my source said it's trial examination, but I don't know how that is to be. Okay, so we are just going to continue with the question. So it says interpretation of financial statements for 35 marks in 30 minutes. And then you are provided with information of Solar Style Ltd for the financial year ended 29 February 2020. So the business provides your solar panels to households to supplement their electricity supply. So whenever you're dealing with interpretation of financial statements, this is the question where you have to think outside the box. You have to use your critical thinking. You have to have your thinking heads on. All right. So getting into the first question, or even before that, it says required. Note, provide figures, financial indicators, or calculations in each case to support your comments and explanations. Right. So getting into the first question, it says solvency and liquidity. Comment on the solvency of the company. Quote one financial indicator with figures. This is really important. You quote a financial indicator with its figures. What are we looking at? We're looking at solvency of the company. So whenever we're looking at solvency, we're looking at whether the company is going to be able to settle its long-term liabilities and also its short-term liabilities using its total assets. So what I mean by that is whereby you have your total assets to your total liabilities. This is your solvency. Right. So looking at our information, we are given information A and information B, C, D, and E. So those are the 5 pieces of information that we're given. All right. So looking at information A, we are given net profit after tax, and then we are also given your net current liability, and also information B, which is your financial indicators calculated. Okay, so the first question requires us to comment on the solvency of the business. All right, so the first one that we're going to look at is this is a fun color. Here you have your total assets to total liabilities. Should be an easy one. So you can see that on the 29th of February 2019, it was 5.0 is to 1. But now it decreased from 2.0 is to 1. What you're going to do, you have your indicator, you have a trend, you have figures, and then you comment. This is usually the standard order of how to get full marks when you're doing your financial when you're interpreting your financial indicators. You first state your indicator, you indicate the trend along with the figures, and then at the end you comment. All right, let's just do that. The indicator, it's total assets to total liabilities. Now you state the trend. Decreased from 5.02 is to 1 to 2.0 is to 1. Okay, now this is your indicator. This is your trend. These are your figures. Now what you have to do is comment. All right, so that's the standard procedure that you can use to answer such questions. Now, as you have stated that your solvency decreased from 5.0 to 2.0 is to 1. What you can say about this is that the business is solvent. As much as it decreased from 5.0 to 2.0 is to 1, it is still solvent. I don't think it's going to cause the business any problems. So the business is still solvent, although the solvency declined. You can even state the difference that it declined by, let's say, 3.0 is to 1. Alright, so by 3.0 is to 1. Then the next question, it says, explain why the directors are satisfied with the change in the liquidity of the company. Now, you quote 2 financial indicators with figures. So when you're looking at your liquidity, you are most of the time looking at your current liabilities, which are your asset test ratio and your stock turnover rate. So we're gonna start with the stock turnover rate. So the stock turnover rate increased from 3 times in the previous year to 6 times. This simply means the business has bought stock 6 times this year. All right, so stock turnover rate increased. I'm really trying my best with the handwriting. Increased from 3 to 6 times between the 2 years. Okay, between the 2 years. So you can even say sales have increased, because when you're buying more stock, that simply means people are buying from your business. All right, and then the second one, if you come here, you can check your asset test ratio. So it decreased from 2.6 is to 1 to 0.8 is to 1. So why is this decrease significant? It is because your asset test ratio, it is whereby you do not include your inventory. Remember, when you're calculating your asset test ratio, it's current assets minus inventory is to current liabilities. So this ratio actually tests whether the business is going to be able to settle its current liabilities without the use of inventory. That is why we are eliminating inventory from our current assets. It tests whether we're going to be able to pay current liabilities without the use of inventory. If we do not sell inventory, are we going to be able to pay current obligations? So that is why, if it says your current your asset test ratio decreased from 2.6 is to 1 to 0.8 is to 1, that is significant, because it simply means that the business is now is more efficient in its productivity, in turning its inventory into cash. Okay, so we're gonna say asset test ratio decreased What's the figure there? Okay, 2.6. 2.6 is to 1 to 0.8 is to 1. Now, business will be able to settle short-term, or you could say current. Okay, so let's say short-term or current liabilities as it became more efficient. Right, so now we are going to check the next question, and we can just simply look at it from our answer book. So it says, comment on the percentage return and earnings per share, right, of the company. Now quote 2 financial indicators with figures. So this question just states that you are to comment on your percentage return and your earnings per share. So that's where we're definitely going to start. Percentage return, that's where you're looking at your percentage return on average equity, your share. Okay, so that's where you're looking at your percentage return. Now we've stated, so we're going to look what happened on the Roche. So it decreased from 8.7 to 5.3%. So you can just say 2019, 8.7%. These numbers. Let's say 8.7%. And then 2020, it was 5.3. 5.3%. So it decreased by, let's calculate the difference here, 8.7, 5.3, 3.4%. So that's quick math. If you're not really good, you can use a calculator. So it decreased by 3.4% between 2019 and 2020. Right, now we're looking at the percentage earnings per share. So earnings per share, there we go. So earnings per share, if you could look here, 72 cents and 96 cents. So this simply means your earnings per share is just your profit. It shows how much profit have you made per share. So this just shows that your earnings per share decreased from 96 cents to 72 cents. Let me see if this is the correct amount. Yes, 96.72. So what does that mean? Like I said, your earnings per share shows your profitability per share. So shows a decline in the profitability of the company. Right. So the return also, you can return on shareholders' equity. You can also check with your alternative investments. So your alternative investments are fixed at 6.5%. Okay, but now your investors have earned 5.3%, which is actually lower than, let's say there was a bank that was offering interest at 6.5%. but they got to get 5.3% in your business. This simply means they can easily leave your business and go invest elsewhere. Okay, so you can also say it is lower than the 6.5% of alternative. Okay, let's just take this of alternative investment of alternative investment. Right. So now we move to 3.2.2. It says comment on the share price on the JSE and how the percentage return and the earnings per share have affected the share price. So market price, this is what we're looking at. Share price on the JSE, and then percentage return, and how the earnings per share have affected all these. Remember that we were looking at your earnings per share. We're talking about profitability per share, right? Now your percentage return, this is just what we were looking at. The question 3.2.1. We said your investors may be able to move to other businesses, remember, to invest in other businesses, or let's say just a simple bank that's offering an interest of 6.5%. Okay, so now how is that affecting our share price on the market? So first, let's just start by stating our market price of 920, it decreased from 920 to 840 cents. So the market price decreased, or let's just say declined from 940. Is it 940? Oh, 920 and 840. Sorry. So it's 920. It's really important to double check from 920 to 840 cents. Right? And then now our percentage return, still I'm saying the same thing. It just says that as it decreased, as percentage return decreased, investors, or we could just say shareholders, investors are no longer confident in investing in the company. I mean, how can you invest in a company that is not yielding a higher percentage return than any other company? So it says as percentage return decreased, investors are no longer confident in investing in the company. So this just it just shows that investors are no longer in support, so that drops the demand for shares. So we can also add a drop in the shares demand. Okay, so now we are going to talk about earnings per share. Earnings per share also declined. Thus, so if they're earning less, they can see, okay, I'm going to this company to invest, but it had a less earning per share. So that's profitability. So you're just going to state that now the profitability is low. It declined. Thus, your investors, it's actually the same reason. So now we can move on to your market share price, comparing your market price with your net asset value. What does this show? If you have your market price here at 840, this current year. And then you have your net asset value per share, which shows 8.77 cents. This literally shows that your shares are valued at a higher price in the books of the business, but are sold for less at the market price at the JSE. This simply shows that your shares are really not in demand, or it can just shows that it can show that the demand for your shares is getting lower and lower. So we can just say net asset value is greater than the market price. I'm just gonna say MP is greater than the market price at 8.77. This shows that the demand of shares is decreasing. So it's really important to get straight into the point. Make sure that you support your answer with figures. Each and every time you make a comment, make sure that you have stated your figures and it is relevant to what you're actually talking about. Get straight to the point. Do not write paragraphs. Just state what you want to state, because paragraphs are just gonna make everything irrelevant. Okay, so now we're just gonna simply move to 3.3, and then 3.3 says explain how the loan affected the risk. Now we're talking about risk and gearing, and whether or not it was a good idea to increase the loan. Quote two financial indicators with figures. So we're just gonna go back to our information and find out what really happened here. It says extract from the financial statements. This is where we get our loan. All right. So on the 28th of Feb 2019, we had a loan of 2 million. Now we increased the loan to 3,500,000, which means we increased the loan by 1,500,000. Okay, so we increased the loan. Now when we're looking at our loans, this is where we get your financial which what they call gearing or risk. Okay, it's not the same thing, but I'm just gonna explain it briefly. So when we're talking about risk, we're talking about how liable is a business when it comes to paying back your debt. So the first thing that we look when we're talking about risk is debt is to equity ratio. And then when we're talking about gearing, right? Is the business efficient in using those loans? Is it efficient? So with gearing, there is positive and negative gearing. So when it's positive, the business should be able to make a higher return on the loans. That is where we get to talk about your percentage return on total capital employed, what you call your ROTCE or your ROTCE. So if the business is efficient, it is going to make or it is going to use the capital employed efficiently. That simply means your percentage ROTCE should be higher than your interest on loans, because your interest on loans is actually what you pay extra for borrowing the loan. And are you making more money than what you're paying back on the loan? That is what we call gearing. Are you efficient in using those loans at that certain point in time? Okay, so what we're going to look at on this question is it says explain how the loan affected the risk and gearing, and whether or not it was a good idea to increase the loan. So like I said, we're just going to look at our debt to equity ratio. So the debt to equity ratio If I remember very well, it decreased or it increased from 0.3 to 1 to 0.4. It increased from 0.3 to 1 to 0.4 to 1. As an accounting student, you should know that if it is lower, let's say even equal to, we consider this as it is. If it is lower than this, we consider that as low risk. If it is greater, let's say it's 0.8 is to 1, we consider that as high risk. Cool. So we can just comment on the risk. We could say the business is still low risk. Right. Now we're looking at your percentage ROTCE. Decreased from, so it decreased from 11.6 to 6.2. Decreased from 11.6% to 6.2%. So now you can conclude if the business was efficient or inefficient in using the loan by comparing with your interest on loans. So interest on loans, it was 12%, but now decreased to 10.5%. But still, the business was not able to utilize such because they were only able to achieve a return of 6.2, whereas they paid 10.5% on interest, which means they actually made far less than what they paid on interest. So utilizing the loan, it has not really been efficient. So it was not really a good idea to increase the loan. So therefore, not a good idea to increase the loan. And then you state your reasons. ROTCE, percentage ROTCE of 6.2% is lower than the interest on loan. Always state figures. Interest on loan of 10.5%. Now, whenever you're looking at your risk, you're also going to check your financial profits. Okay, so now you're just also going to state that profits decreased. Profits decreased, but the financial risk of the company, financial risk of the company increased. Cool. I genuinely think that would be enough for the whole 7 marks, because I would say, okay, let's say here they would give 2 financial indicators that give a mark, okay, and then they give a mark for figures, and then they give, let's say, how many marks are there already? 4. Now you're gonna fight for your 3 marks, stating your reasons. Okay, so I really think that would be enough for 7 marks. And then I'll refer to information D, and then information D is supposed to explain how Alan's decision affected his percentage holding. Provide a calculation to support your explanation. We head straight to information D and see what information D has in store for us. So information D says, let me just use a different highlighter. Let's use this one. So information D says shareholding of Alan Bata in Solar Style Ltd. So I think we are supposed to start here. Okay, shareholding. So refer to information D. The directors decided to offer the existing shareholders 1 share for every 5 shares they own on the 1st of September 2019 at a price of R6.50 each. So Alan Butter currently owns 45% of the shareholders of Soda Style Ltd. Alan was one of the few shareholders who decided to accept this offer. Right. Now it says explain how Alan's decision affected his percentage shareholding. That's what we're focusing on. And provide a calculation to support your answer or your explanation. Right. Information D. Shareholding of Alan Butter in Solar Star Ltd. So the number of shares that he owned at the end or at the start was 360, but at the end we don't know. So it said 1 for every 5 shares they own. How much does he own? 360,000 shares. Cool. And how much is that? Let me just get my calculator real quickly. Okay, so that's 1/5 times 360. That's giving me 72,000. So he bought 72,000 more shares. More shares bought. So you can either interpret this, let's say for every 5 shares, so we're just gonna say 360 divided by 5. That's what we actually did, because for every 5 shares, how many shares that does he have? He has 72,000 shares. Okay, so he's able to purchase 72,000 more shares at R6.50. Okay. All right. So that's our calculation. I'm just gonna say to get the total number of shares that he owns. So it's 360 times 1/5 plus the 360 that he already owns. Okay, that's gonna be 72,000, which will give us. Let's see what we get there. So 360. That's what's this? 72,000 plus 360, which is 432 shares. Right. So he owns 432,000 shares. And then now, how does this affect his percentage shareholding? Remember that at the end, how many shares were issued at Solar Style? 900,000, right? Remember before they told us that he owned 45%. Let's calculate his percentage shareholding now. Okay. So it's 432,000 over 900,000 shares times 100, just to see his percentage holding, what that is. Okay, let me just clear. It's 432 over 900, and that gives me 0.4. Okay, that's 48%. 48%. Okay, so it increased. So percentage share holding increased from 45% to 48%. Okay. You can even state that it increased by 3%. 3% increase. So if you feel like you've got enough time and it's just gonna give you more solid answers, even on the previous questions, you can just state the difference in each and every question. All right. So now it says give 2 reasons why Alan might have made this decision. First of all, here, what we're going to check is the price. At the price at which he bought the shares. Secondly, we're going to look at his percentage shareholding. That was what we're going to focus on in this question. So the price we're going to look, he bought them at 6 Rand 50 per share, but the company is allowed to sell shares in the market at 840 cents. Okay, which is 8 Rand 40. And your net asset value is also 8 Rand 77 cents. He got these shares at a way less cheaper price. That is why no one would literally would let go of such an offer. So the first thing you could say, he bought the shares at a lesser price. So you could say market price is at 8 Rand 40, and then 8 Rand 40, but he bought the shares at a lower price of 6 Rand 50. Also, you can just state the difference. So my quick math is really not working. So it's 840 minus 6.5, which is 1 Rand 90 cheaper. And then the second one, that's what we were talking about as his percentage shareholding. So now he holds 48%. He only needs a few more shares to actually be a majority shareholder. So to be a majority shareholder, you need 50.1%. Yeah, that's only what you need. Or you need 50, let's say just 51. So he only needs only two more percentages. He needs only 2%, or let's say just 2.1%. He needs only 2.1% to be majority shareholders. And when you're a majority shareholder, sorry about that. So when you're a majority shareholder, that's where you get to make most of the decisions regarding the business. So another reason could be what let's check what the business sells. So the business sells your solar panels, right? And looking into the current ESCOM issues, your load shedding and stuff, the business is yet still to make much more money. So I think he could be buying more shares in order to increase his earnings, to increase his profits, his dividends. So this is where you actually have to get your thinking hats on. Like I said at the start of the video, you don't really need to coop yourself inside the box. Think outside the box and utilize each and every answer that comes your way. So there isn't really an incorrect answer here. Okay, I'm just gonna leave that to you and give it more time to think about. Okay. So 3.5.1 says one of the directors feels that the dividend payout rate should have remained constant. So the dividend payout rate we were not given. We were only just given our EPS and our DPS, dividend payout per share. Alright. So what we're going to look at is our dividend payout rate. It should have remained constant. Give one possible reason for her opinion. So what we paid the previous year, we paid our shareholders 48 cents out of the total earnings of 96 cents. So 48 of 96 times 100. 48 is the half of 96. Okay, so that's 50%. So this director says it should have remained at 50%. Okay, so if it should have remained at 50%, now we have earnings per share of 72. What is 50% of 72, that's gonna be 36%. No, 36 cents. 36 cents. Sorry about that. 36 cents per share. So that should have been your dividends per share. So we're just gonna take that calculation and just plug it in. So 48 over 96 times 100 is equal to 50%. So, but remember that your earnings per share for this year was 72 cents. So we're stating that the DPS could have been 36 cents and not 48 cents if the dividend payout rate remained constant. Okay, so that I think that is all we need to know about such. Okay, so 3.5.2, it says refer to information E, explain with figures why one of the shareholders, Naidu, feels that the dividends she earns in Solar Style Ltd is not as good as those that she earns in NetGen Ltd. So we're comparing her dividends that she earns in both companies. Okay, so information E. Let's see. Now, shareholding of Naidu in two companies. Dividends per share that she earned in Solar Style is 36 cents. In NetGen, 28 cents. Now we're going to look the price she paid for her shares. Now she paid 820 cents on Solar Style, and in NetGen she paid 400 cents. So she actually paid more on Solar Style, but receiving only 36 cents. But at NetGen, she paid 400 cents, but only receiving dividends of 28 cents. If you could check, this is almost it's even more than double of this, because and then if it's double that, why can't be the shares also be double? Why this can't be the double of that, and we are able to get 56 cents there? You can simply see how this is appropriated. So this simply means that she is not receiving value for her money at Solar Style Ltd, but the dividends per share that she gets at NetGen are actually worth it because she paid less for the shares. So how can you put this into writing after our analysis? So you can just say 36 cents over your, okay, let's just make this a certain percentage that we can use. So now we're talking about your dividend, what we call dividend yield. So it's 36 over 820 cents times 100. Dividend yield at Solar Style. Let's see how much that is. Okay, so it's going to be 36. Okay, just a minute. 36 over 820 times 100, which is 4.39%. And then dividend yield at Solar NetGen. So she received 28 of 400 cents. do that quickly. 28 of 400 times 100%, which is 7%. See, she dividend yield is higher at NetGen Ltd. Thus, we can just hence. So now we're answering what we're asked. Hence, the dividends she earns and NetGen are better than those earned at Solar Style Ltd. So another thing that you could explain is that of the double price that I was stating, and I really think that is it to today. Total marks 35, and I really think we have done enough for today on our financial indicators. I really hope that was productive and really helpful. I hope you got everything that you needed to grasp today. Please don't forget to subscribe, comment, and share with your friends and family, even schoolmates that need help with accounting. I'm here to help you guys ace accounting. I will definitely see you in the next video. Thank you for watching.